Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 414. I am Brandon Roberts.
And I am Brantley Whitley.
You are listening to the internet's favorite podcast about life insurance.
I thought you were just going to say the internet's favorite podcast, period.
One day, we wish to be at that place. But today, there's one or two ahead of us.
Yeah.
This bald guy in Texas who just holds some really good numbers.
I was going to say, first we got to get on Rogan, and then we can get closer.
He's got 1 million or 2 more downloads than we do each week.
I don't know what we would talk about for 3 or 4 hours. That would be
nothing exciting.
Be the shortest episode ever. Like, sorry, Joe, I don't have that many words.
Nope.
I'm all out. We usually do a tight 30. That's it.
So today's subject's whole life insurance.
Oh, yay.
Following on the heels of last week's exciting discussion about real index earnings for index universal life insurance, we figured what we would do is, we don't have a really great analog in that sense, but what we can pull from our whole life data is, what is the average year over year growth in cash value for whole life policies in our book of business?
Yep.
So we have
going back over 10 years.
Yeah, pulled the data.
So we've seen dividend decreases and increases over that time.
We have indeed. And we've seen policies issued by different companies, different style of products. People do different things with those policies, fund them like they were supposed to, not fund them like they were planning to, take loans against them. This encompasses all of that.
Yep.
So
it's a good cross section.
It is. And the average across all of these whole life policies in force for us, year over year growth. So what's going to happen right now is 5%.
Sounds about right.
Mm-hmm. Now,
I would say, I'm shocked. I can't believe it. It's like, it's pretty much what I would have thought.
We've been doing this way too long. We can't do that. We're jaded. Like, no, that figures. Next.
I've looked at so many of them, and that's about what I would expect.
Yep. I do want to be clear about something, though. So I don't want people to misinterpret the numbers here, because they may go back to last week and go, wasn't it like 7 something? Yes, but that is the average index earnings from inception to now.
Right.
That is not the same as what the growth in cash value is this year.
Right.
We can make certain insinuations about this data. We're long-term believers that index universal life insurance is going to perform better than whole life insurance in terms of rate of return on cash value.
Yeah.
We do believe that.
It should.
Yes, there's a risk component to index universal life insurance in terms of the choppiness, if you will, of the year-over-year earnings that should give you a little bit of a premium when it comes to what you'd expect from it.
Yep.
That being said, a 5% being the growth in policies on average this year, that's pretty good comparatively to what these things are accomplishing in their lifespan from inception to now with respects to growth in cash value.
So, and this encompasses policies that are still, where premiums are still being paid, and policies that are not, right?
Correct.
Because some people buy I just wanted to point that out. Like, some people buy whole life insurance in particular. Some people come to us and they only want to pay premiums for 5 years.
Yep.
Or I'm just using 5 years as an example. It could be 7 years. It could be, I think we've had a couple that were like 3 years. And there are things that have to happen to make that possible. But I just wanted to show that it's across the board. These are not exclusively people who are still adding premium to their policies.
Nope, not everyone. Some of them have stopped. And so they are just collecting increases in cash each year.
Yep.
That comes in 2 different forms for whole life insurance. There is a guaranteed accumulation of cash value interest on a whole life policy, and then there are dividends.
Yeah.
So that's
but
how
the
it comes
dividend
together.
was 6.5. How come
it doesn't work that way?
5.
Now, something that is definitely going on. So there's a big range. Well, there's a range. Big is subjective in terms of kind of the lowest performing and highest performing. Nothing is below 4% here.
Right.
We have as high as 6%. And I'll reiterate something we've brought up before. I think you bring it up more often than I do. The fact that if you have a policy that starts out year one in a negative rate of return, you go out, let's say 15 years, and it says it's going to have a 4% rate of return.
Average.
That then means that the rate of return year over year as the policy ages has to be growing substantially to make up for that year that it was negative.
Yeah.
Or years that it was negative.
It accelerates.
And that's if we were to plot this data as age, we would see that trend.
Yep.
So if we were going to look at this as what are they accomplishing and how old are they, we definitely see the older policies are the ones that have the higher growth in cash value year over year.
Right. Yep. Absolutely true. All the time.
And I think one of the fascinating things about whole life insurance in particular, because the aspects are not guaranteed, but given the functionality of the policy, they're pretty much the closest thing you're ever going to get to a guarantee. The fact that some of these policies can be in existence today and the growth in cash value from last year to this year is something like 5.5%, 6%. That puts you in place where you own an asset that has a very great rate of return that you don't have to worry about.
Yeah.
And I don't know that many places you're going to pick up where today 5% is going to be the growth of cash value, and it's only going to go up from here.
Right. It's not going to be worth. There's not a chance it's going to be worth less next year.
Yeah. And there's a lot of nuance to that. A lot of we take for granted knowing what we know, because everybody's going to show up. Well, what if you bought a CD or a MIGA that paid 6%? You can do that, but probably best you're going to get is a 5-year guarantee on that.
Right.
And then after that, interest rates are going to be whatever interest rates are.
Yep.
Life insurance is doing that for tens of years.
Yep. And it's achieved that the result you're talking about, the current year over year results. As I said, many of these policies started with higher dividend rates than they currently have.
And we're still hitting those numbers.
They dipped lower to where even lower than they are now. Have come back up a little bit in the last couple of years. But not made any huge moves in either direction.
Nope. They have not. Life insurance, the difficult thing to grasp when it comes to life insurance in motion, or whole life insurance in motion, is the fact that we don't really see an event.
I was going to say, the fact is it doesn't move that much.
We're saying the same thing.
It moves in slow. It moves in slow motion.
Yep. And because we don't have an event, it's a slow burn to where it's going.
Yeah.
Which is easy to overlook. But if you look back 10 years ago, 10 years now, you realize, that actually did something.
And that's, mostly across the industry and policies that we see more or less in terms of the year over year rate of return. I'm not going to say that's equal across the board, but they all work the same way with very few exceptions. I mean, there have been some exceptions, like a small company in the Midwest somewhere, perhaps the Buckeye State, where things did not go well.
Yeah.
But with very few exceptions, that being one of them, they all kind of work this way.
Yep.
Now, as I was going to say, the year over year return on cash could be significantly different depending on policy design.
Yes.
And dividend rate, of course, affects that as well. But they all are engineered to work in a similar fashion.
The foundation's the same.
Yep.
there are some other pieces that will change it.
Yep.
And make it work better if you know how to do it. That is for sure true. You know, something that's come up numerous times with policies that we have put in force, going back to your comment and explanation earlier, that there are policies, a number of them in fact, that we put in place that have a finite number of years in mind. So this might look something like, hey, I'm going to only plan to pay premium for like the next 5 years.
Right.
And generally speaking, that happens because somebody's sitting on a sum of money that they have earmarked for whole life insurance as a low risk asset.
Yep.
So we're going to split it up and we're going to put it in the policy over a 5-year period, let's say.
Yep.
And they do that. And we get to the end of that 5 years, and they oftentimes will ask, hey, can I put more money in there? And should I put more money in there?
Yep.
And my answer is always the same. We do the same sort of calculation on those policies at that time and go, well, here are the circumstances. If you pay premium into this policy, maybe it's the original amount, maybe it's some number less than that. The rate of return on cash value is going to be, let's say, 4.5% at that point in the policy's lifetime. If there are other things that you can do where you know for certain you're going to get 4.5% on the money, go do those things. But if you don't know anything that's going to do better than that, and you're not comfortable with the risk of the things that again might do better, might do worse, then put the money in the life insurance. Because here's the deal: if you do that, and you decide next year, 2 years from now, 3 years from now, oh, you know what? There's this other thing, and I'd rather have the money for that. Just take money from the whole life policy and do that.
Yep.
That's fine.
Mm-hmm.
Not only do you have that virtually guaranteed rate of return, you've also got liquidity that other assets don't tend to give you.
Right. And I can't tell you exactly what it's going to be worth 3 years from now, but I can tell you it's going to be more than it is today.
Mm-hmm.
There's not much else you can buy that will do that for you.
Nope. There isn't. So again, with whole life insurance, the nifty thing about the guaranteed side of it is as time goes on, the guarantee gets much stronger.
Yeah.
Because you just have a larger pot of money off which the guarantee is now being paid.
Yep.
And that the guarantee that is put in place on whole life insurance is, I'm going to stop hedging, the strongest guarantee you can find in financial assets anywhere.
Mm-hmm.
It just is. Like if you think about, it was 4 at one time for a long time. Now it's lower than that for a lot of contracts after the tax law changes that came a few years ago. But even at like 3.5%, which is where a lot of them landed, you do not find any other assets that will guarantee that for a lifetime.
Right.
So
I don't know of any, by the way. So.
Right. They just don't exist.
Right.
That doesn't mean it's the place you should put every dollar you've got. No. It just means that it's a really great place to store cash in the meantime.
Mm-hmm.
And
absolutely.
There are a number of things you can do with that. I still maintain the best thing is use it as part of the retirement income portfolio.
Right.
Because it excels at that task.
Mm-hmm.
But if you want to do infinite banking or something of that nature, fine. It works.
Yeah.
We've seen people do it. We've seen people.
Well, then you can do both, right? I mean, that's the thing.
Yeah.
If you pay the loan back and you
then,
give yourself
happy day. It's there for you.
Yeah. You got a substantial amount of money when you do get to retirement that you can use.
Yep. That is very true. So what I really want to point out to people is the idea that whole life insurance is this forever a negative rate of return kind of thing and terrible returns. That's always made in absolute terms without any sort of comparative concept to anchor what makes it so bad.
Right.
I know there are some people, more bald guys who talk into microphones, this time from Tennessee, who will tell you it's terrible because it's not 12%, which is what you'll get in the mutual funds somehow.
Yeah.
I've been around the investment industry for a long time. I've never met somebody who's consistently done that.
12%?
Yeah.
I don't know of any.
No. And I know enough about the world of compliance in that world to know you can't say that if you have an investment license.
It's that unlikely to happen that they won't permit you to talk about it.
So, like, it's bad in what context? I don't really know.
Right.
Because I know a lot of people who have held whole life insurance through varying economic moments.
Mm-hmm.
And they've been very pleased with what it brings to the table when other things are not in a good position right now to sell.
Yeah.
And that opens up the door for opportunity that is really easy to overlook.
Mm-hmm.
But
lots of people were very happy in 2022 with their whole life insurance.
Yep. Having done this for all the time that we've done it, you start to see situations where you realize it's not a straight line to prosperity. And there are a number of things that go bump along the way.
Yep.
And whether you want to or not, they are meaningful pieces to the model that you should include. And it's almost as dumb as the people who say, I'm not going to worry about my auto insurance coverage amounts because I'm just going to drive safe and not get into an accident. It's not the reason you're buying it.
And then you get sued.
I wasn't even thinking about that. But it like really the number of people that I have seen over the years who lost a job,
mm-hmm.
and they weren't meaning to take money from their 401k, but if it's the difference between making the mortgage payment or taking the penalty on a withdrawal from the 401k, guess which one they choose 100% of the time?
Yeah. Retirement doesn't seem all that important when you're weeks away from losing your home.
Nope.
Like, if I don't have any place to live, then that's going to be.
And sometimes the example doesn't even need to be backing the Hearst up. I mean, we've had some situations where people had opportunities at their disposal, but selling other assets that they owned, it just wasn't that attractive at that time, either because they were down in value or because they had serious optimism about where they were going from here. So guess what? We take a life insurance loan and we do it.
Right.
And great.
Mm-hmm.
So overlooking...
And many of them paid it back.
Yep. Overlooking what it brings to the table in that context is just foolish.
Yeah. I agree. And when you think about the return as well, I mean, I'm going back to a point you made several minutes ago, but when you were talking about what else is going to pay you 4+% in perpetuity, and you have to. This is rudimentary, but it has to be more than that because everything else is going to be taxable.
Yeah, you're right.
So whatever you're seeing in the life insurance policy is a net number.
Yep. Which, believe me, as somebody who has on a few different occasions been involved in the distribution of assets for people in retirement, the fewer times you have to worry about tax consequences, the much, much more happy you are with life.
Yeah.
Because it matters. It can trip you up. And some people are of the mindset that taxes are taxes and I'm going to pay them, so whatever. But there are a lot of other people who get really twisted up in terms of what tax liabilities are created when I do this, that, or the other thing.
Yeah. Well, many people, when they retire, are very surprised by the tax liability created from, say, taking money out of their old 401k, which is probably in an IRA at this point, but you get what I'm saying.
Yep.
Either way, they're very, they never did the mental calculus.
Yep.
And so now they're going, well, I need to take this much, but if I take that much, I'm going to have to pay this much in taxes, and that's going to make half of my Social Security taxable. And there's a lot that goes into that, whereas life insurance just has no impact on that. So,
yep.
I mean, we've talked about that extensively, so I don't want to beat that horse. But.
Well, we should beat that horse, because here's the problem that we both have. We know this. We've known this for decades.
Yep.
So for us, it's commonplace.
Mm-hmm.
Like for somebody to come to us and say, do you know that like taxes become a really, really annoying expense in retirement when you start withdrawing from your 401k? We've been there, done that. But it's not our first time. For a lot of people, it's their first time.
Yeah.
They spent their life working their job, dealing with their kids, stressing out over various expenses or decisions they had to make. There was no time to worry about this stuff. So
all the tax deduction you got, they're going to recoup it with interest later.
They want that back. Yeah. Yep. So this is an awakening for them when they get to retirement, to realize that taxes are real.
Yep.
And when you want to withdraw $5,000 from your 401k IRA, whatever it is, and you need $5,000, it can't just be $5,000 that comes out of the IRA.
Right.
It's got to be
$6,500.
It's got to be $5,000 plus enough to account for the taxes.
Right.
Or you just withdraw $5,000 and you need to figure out settling up later, which is a horrendous idea because most people don't keep a running tally.
And most people, especially people who have worked, they've been W-2 wage earners their entire careers.
Mm-hmm.
A lot of them have only paid taxes through withholdings.
Correct.
Or the vast majority of their tax liability was paid through withholdings, at least.
Yep.
Maybe some years they had to pay extra when April rolled around. Most years they didn't.
Or they've had state taxing issues. Maybe they live on a border between a state that does have an income tax and one that doesn't have an income tax. They happen to work for an employer who's in the non-income tax state, which doesn't do withholdings for state income taxes. So they have to figure that out. And the first time they work for that employer and file their taxes, they find out that they have to do that.
Yeah, I hadn't even thought about that. That probably happens a lot up where you are.
Oddly specific example because I know many, many people who have been caught in that trap.
Yeah. Yep. That probably happens here in Georgia, in South Georgia, on the border of Florida and stuff like that.
Yep. So those are times. I remember having conversations with people who recently retired, or even people who have transitioned from like, I was doing this and I decided to quote unquote retire, and now I'm working 1099 somewhere, and finding out for the first time that I have to deal with all that. And actually, those people are in a really good position because it's kind of like a trial run for retirement to figure out like the process of withholdings and the mental gymnastics that have to go into that. And it's real. Like you do have to put yourself in a different mindset.
Yep. And
be ready for that. So when
I made $4,000 this month. You made $3,000 this month.
Right. So money that is not taxable is good. I'm not saying all of it needs to be. I'm not saying that at all. I'm just saying that a portion of it being non-taxable does give you some options that you don't have when it's all taxable money in your 401k, for example.
Mm-hmm.
So
Did you see any correlation between when you were parsing all this data? Did you see any correlation between? Was there anything that made a policy perform better or worse? I guess is what I'm getting at.
Not that stood out
I mean, of the things you could control as an
Yeah.
individual, I don't mean dividend rates are, none of us can control that.
Mhm.
Yeah.
I mean, in a very limited sort of respect, but I don't think for me personally, there's enough data points to say definitively. But, for individuals who bought policies at a younger age and funded them with more money, those are the ones that tend to be a little better off in terms of what I see.
When you say more money, I know you mean literally more money, but
yeah, right. I mean, like it was a $50,000, $100,000 premium versus a $2,500 a year premium.
Right. But I want to draw a correlation between why that is.
Yeah, sure.
And my hypothesis, and you can tell me if I'm right or wrong, but my hypothesis for that would be that your premium amount at that $50,000 or $100,000 level is so far above what was required for the given death benefit as a percentage of what you paid, that you're just able to put more money to work in the growth engine of the policy.
Yeah.
Through paid up additions mostly.
Yep. There is a small amount of scalability as the incoming premium goes up in most cases for people. People often ask when we're looking at proposals, well, what happens if I do double this? And the answer is it's not going to be exactly times 2 what you see. There is a little bit of scalability to it, but it's close enough to get an estimation.
Yeah.
Realistically. There isn't a magic number in terms of doing 2.5 times more premium than what you're planning on doing is going to put you in some magical world where all of the secret doors unlock and everything's great. But there is a scalability to it in most cases. As the amount goes up, there's going to be a slightly enhanced rate of return on this.
Yep.
And we do see that here.
I was going to say that's consistent with what we've seen over the years for sure.
It is good, I think, to see that subsequent iterations of whole life policies, so this means somewhat newer ones, are holding their own with some of the older stuff. We mentioned last week when it came to some of the indexed universal life policies, there were iterative changes, and we weren't always happy when those announcements were made. But the good news is those subsequent policies seem to be doing just fine. And I would say the same is true here with the whole life policies.
Yep.
Now, I think we caught some criticism a few years ago because we were a little pissy about the way whole life was developing as far as product changes
or not developing.
Yeah, and some of that was because we remember 10 plus years ago when they had some different features available to them that were going away, and it turns out that even though that's happened, it hasn't significantly handicapped growth in those policies. They've done okay, and there's been some recent shifts as far as the industry goes and product availability goes that have been a breath of fresh air, at least for me. So that's good news. But we would comment back then, look, don't wait, because this stuff hasn't gotten better as new iterations have come along.
As it pertains to whole life insurance.
Correct.
Yeah.
The one thing that's
that I would say, largely true.
Yeah. Yes. And the other thing I would say is, I mean, people who bought younger are definitely benefiting from compounding over time.
Yeah.
People, I think there's a tendency to assume, right. I think there's a tendency to assume that, it's because you're younger and insurance is cheaper. Not really, because death benefit is relative to how much is necessary in order to fund it correctly. So, 35 versus 45, there's not going to be a huge difference in terms of expense per se, because if we're doing this the right way, the 45-year-old's going to end up with less death benefit. And that's going to mitigate a lot of that supposed difference in expense. But if you're 35 years old, you get 10 years of compounding that the 45-year-old probably doesn't have.
Right.
So that's going to make a difference.
Yeah. That will absolutely make a difference. And some of the people, I know some of the policies we had, some of the whole life policies we had on the books that were shorter pays were people who were quite a bit younger.
Yeah. They were.
30 to 40-year-old range.
Right.
And that really benefited them.
They've all got policies. They've all done well. They've used these policies. Some have taken loans to do various things, paid them back.
But a lot of those, in particular, those short pays, I always call them, they're in paid up status, right?
The ones that actually did plan for that and do it, yes, they moved into paid up status.
Yeah. And I only bring that up because that definitely accelerates your growth rate if you get to that point.
Yeah. So it keeps existing. It keeps growing. And, I was having a conversation with somebody recently about real estate. And his contention was...
It's your favorite subject.
Yeah. His contention was the house that he owns, he bought decades ago for, as he put it, practically nothing. And now it's worth a lot of money.
Mm-hmm.
And he knows a bunch of people who are selling their houses because they've got all this equity and they're cashing out. He's like, why would I sell? I'm making all kinds of money. And I think to myself, well, I mean, it's true, but it's kind of a vanity metric in the sense that you can't
You're not
do
making a lot of money.
Right. You can't really do anything with it. Whole life insurance is different.
Yep.
It's going to grow and you can actually do stuff with that.
Yep.
A lot more easily than you can with real estate. I know the real estate people, the real estate bros are going to come along. Oh, you did equity line of credit. Yeah, fine. You can do all that. It's easier to do it with whole life insurance. It just is.
The phone call.
There's a whole lot less risk when it comes to the underlying asset and its continued value.
Well, you still get paid.
You do.
You take a loan, you still get dividends. So,
and you definitely get guaranteed interest.
Yep.
So it works. The growth rate accelerates over time, which is fantastic.
Mm-hmm.
And there's a lot of reasons to look at whole life insurance as an asset option.
I agree.
And that is everything.
That's why we're still doing this. If you come up with another conclusion, I would hope you would have told me beforehand before we did the podcast, because that would be.
No, I was gonna just tell you this is it's all crap and this is my plan to leave. But no, good luck.
It turns out it works.
Yep.
Awesome. All right.
All right. Well, I'm Brandon Roberts,
And I'm Brantley Whitley,
and we will see you next week.